Hello, I'm Bernard Hickey from interest.co.nz and g'day Nigel. Nigel Gaudin is the Head of Financial Markets at Kiwibank. Nigel, for people who have a small business that may be either exporting or importing, how can they manage their foreign exchange risk, which with such a volatile currency is a big thing for a lot of businesses?
Yeah, certainly, Bernard. And you're right. I mean, it is a very volatile time. You've only got to look at the last week to see that the New Zealand dollar's fallen 5%. Without too much, of what's going on here in New Zealand. A lot of it's been influenced by offshore activity. So, for small businesses, the key really is there are a number of mechanisms that they can use to hedge their foreign exchange risk, and it really does come down to the individual, the risk profile of their business, and really the cash flow cycle of that business as well. Because at the end of the day, you've got to ask yourself, what are you in the business of doing? And for most small businesses, it's about building a widget or servicing a certain part of the economy, as opposed to foreign exchange speculation. And if you don't hedge your risk down, then all you are ultimately doing is opening yourself up to that speculation.
So let's say I'm an exporter. How do I hedge my risks?
So there's a number of ways that you can hedge yourself. You can convert your foreign receipts at just a spot rate or a daily rate of the day. You can take a forward exchange contract, you can take a foreign exchange option, like an insurance policy, or there's other more complex transactions as well, be it a trade finance facility, foreign currency overdraft. So there's a number of hedging tools that you can use, and at the end of the day, it really does come down to the individual, because two businesses can look very similar on the face, but underlying that, the financial management of that company might be very, very different. And as I said before, the risk profile of the individuals involved as well will be different from company to company. So the mechanisms that they use, the tools that they use, and how they deploy those will be quite different.
So it often depends on the way that your cash flows are structured, doesn't it?
Absolutely.
Because it's not just about when the money comes in, it's about how it goes out and the various timings of that.
Correct. And the other thing too is that, what is the cash flow cycle of your business? How long does it take from when you produce a good and export it overseas before you receive that money back? And that time frame can have a big impact on the tools you employ as well. If you have a very short cash flow period, then you may well just be happy to receive the funds into a foreign currency account and convert it spot. But if you've got a long lead time where you're 5, 6, 7 months duration, then you probably want to employ something like a forward exchange contract or a foreign exchange option to give yourself certainty of the rate that you'll convert at when you receive those funds back.
How easy is it to do that though if you're a small business? Because it sounds like a complicated thing, is it?
Yeah, I mean, it sounds complex, and they are complex transactions, but at the end of the day, with everything else that's going on in the business, it is just another financial tool, and it's not something to be scared of. They have the absolute purpose to lock it down, lock in your exchange rate, guarantee what margin you're going to make, and then move on to the next part of your business.
Because there is a temptation for some people to think, actually, I know where this currency is going. It's overvalued or it's undervalued. I'll just take a bit of a punt. Talk us through some of the risks there.
Yeah, so I mean, as we said before, the last week is a classic example of people trying to second guess the market, and the New Zealand US in the last week has gone from above 85 cents to below 81. So a good example is that if you're an importer, say, sitting there last week deciding whether it was going to stay at 85, go to 88 or 90 cents, which some people have been saying, or back below 81. I don't think there was too many people last week saying that it was going to go back to below 81 within inside the next 5 days. So, a good example of if you had some hedging to do because you were importing some product, if you didn't hedge that last week, then all of a sudden this week you're looking at a rate that's 4 cents lower. So even on $20,000, that's the best part of $1,000 extra that you are going to have to pay for the same New Zealand dollar equivalent. So, I think it's just a good example of how very quickly these things can move. Nobody's an expert, I'd like to say. The market is huge, and the trade side of the business, so trade flow, has very little impact on the actual underlying currency here in New Zealand. There's a lot of offshore investment, there's a lot of capital flows, and so there are a lot of other things going on that influence where the New Zealand dollar moves. And so when you're looking at it from a business perspective, you do just have to look at it from your own scenario, decide where your costing levels are, what's the best way for you to hedge based on your business mechanics, and just lock it down and move on.
And Kiwibank have some people who are willing to and able to talk through these sorts
Absolutely.
of risks.
So we run a financial markets business where we sit alongside our clients, understand their cash flow cycle, their underlying business requirements, what currencies they're dealing in, and the hedging levels that they need to try and hit, or the costing levels that they have within their business. And then we'll help with working them through what are the best mechanics for them, what are the best hedging tools, and then talk to them about when the best time might be to instigate some of those hedges.
And what sort of trends are you seeing over the last year or so about how people are thinking about their currency risks or hedging their currency risks? Are there any particular ways they're doing it differently?
I don't think so. I think at the end of the day, everybody has obviously watched the New Zealand dollar appreciate significantly in the last 3 to 4 years, and obviously we've been sitting at a high level for the last 12 to 18 months. So I think people may have become just a little bit comfortable with the fact that the currency is sitting up here, and so from an import perspective, importers probably have been taking less hedging than exporters. But at the end of the day, I think we are seeing companies being more proficient with their use of forward exchange contracts. We are starting to see exporters use options a little bit more. But at the end of the day too, the currencies that we're seeing people using, obviously there's a lot of trade going into Asia, so it's probably the mix of the currencies that they're using as opposed to any major change in trends around hedging itself.
Excellent. Nigel Gaudin from Kiwibank, the Head of Financial Markets. I'm Bernard Hickey for interest.co.nz.